I have been talking to people about their investments for some time now, and people are the only thing that keeps this interesting. Investing is a solved problem. I used to think that there were geniuses out there with some secret recipe for investment success, or a class of people a cut above us normal folks who had the inside scoop on market beating returns. But it turns out there isn't. We know what works. It's not particularly exciting, and that's just one of the reasons people go looking for the weird and wonderful. In investment management, it's one of those weird places where when you pay more for it, you would expect a better outcome. But in my experience, it's largely the opposite. So in this video, I'm going to give my insight into the 3 biggest investment mistakes I see people making, and hopefully you can avoid these on your investment journey. Fear of missing out is one powerful force. And when you see the likes of the Wall Street bet crowd hyping up their GameStop wins, or the Dogecoin millionaire talking up his latest meme coin purchase, it does grab attention. Remember when they locked us all up for months and we went so mad that we thought that people that bought NFTs were the in crowd? And then you read that even Justin Bieber himself fell prey to the hype? We're human. We've been hardwired with a few biases that will make us want to invest in what's working now, the flavour of the month, rather than what's always worked. And this mistake isn't always as chaotic as investing in some celebrity-endorsed crypto nonsense.
Like I was saying, it's FTX. It's a safe and easy way to get into crypto. Yeah.
Sometimes it's just leaning towards recency bias and forgetting that the world around us can change. Over the last 12 months, AI and technology stocks have been having an absolute ball. You only have to look at the Nvidia stock price to get a feel for this. And the Magnificent Seven, as they've been dubbed, have been pretty much carrying the stock market in recent history. But if we look back to the turn of the millennium and who was the big players in the US stock market at that time, you'd have been looking at names like General Electric, ExxonMobil, and Pfizer. Yeah, Microsoft was up there, but Apple, Amazon, Google, Tesla, Netflix, these weren't really even contenders. If you are looking at recent returns, it's tempting to solely back these very familiar companies and hope that their dominance is never challenged. We've got a whole new generation of investors finding information in new ways, so it's no surprise that they will be drawn to investing in just these companies, or perhaps just US stocks in general. But in a world where BlackBerry, Blockbuster and Kodak were thriving businesses until they weren't, we have to remember that the status quo can change, and it can change quickly. Think back to the early 2000s, it seemed like technology stocks were all the hype. And yes, the internet was a game changer, but not everything with .com in the name was destined for greatness. And there's echoes of this a little bit right now with AI becoming such a buzzword. Just ask Japan about being the flavour of the moment until you're not. So rather than getting caught up in the hype of the day and plunging all of your hard-earned money into Apple stock because you just can't see past the iPhone being the best invention known to man, be wary. A sensible portfolio has global diversification, a spread of industries. It looks at the evidence over long periods of time. It doesn't have to be complicated. You might just be tracking global shares generally, and you might do this through a single fund even, but I would be wary of getting caught up in the here and now. And lastly on this, for any of that weird and wonderful stuff that has the get rich quick kind of feel, I know that regardless of what I say here, people will be drawn to it and people will dabble, but please proceed with caution. If it can make you, it can break you. Don't let short-term wins confirm your biases and then go all in on it. Consider whether it was potentially luck rather than genius that got you that win, and perhaps it's time to walk away from the table.
Sir, you have 18. You don't want to hit. He doesn't want to hit. Hit me. Want to hit.
If you thought Taylor Swift had a cult-like following, try messing with the dividend crowd. The divvies... Actually, that sounds a bit harsh, doesn't it? Sorry, the people who love dividends just cannot stop preaching about it. And hey, you buy a share in a company, it makes a profit, kicks you back some cold hard cash. What's not to like, right? Well, I'm not saying that the dividend isn't an important part of the overall return from investing, just that the dividend in itself isn't something that should be sought after or enshrined. In simple terms, after taxes and expenses, if a company has excess profits, it can do one of three things. It could simply retain the cash, it could reinvest that cash within the business in the hopes of growing in future, or it could pay that out to shareholders in the form of a dividend. Now, if the company does choose to pay out a dividend, say $1 to shareholders, then the value of that company, and thus the share price, should fall by the exact same amount. Now, there are obviously other factors and things that could influence the stock price during that day, but all else being equal, that's what should happen to the price. It's not magic money on top of your return, it's just part of the overall turn from holding shares in that company. You might argue that you would prefer to see the company reinvesting that cash within the business with the aim of growing their future earnings and thus boosting the share price for you as a shareholder. Now, I do appreciate that for particularly mature companies with a strong cash flow, it's going to make sense to pay dividends to shareholders because, one, it helps retain them and it can attract people to investing in the company. And suddenly, if you stop paying the dividend, that's going to have an impact on the stock price. I'm well aware of this. I'm not even saying don't include these companies within your portfolio, but to completely exclude stocks that don't pay a dividend or even just underweight these, you could be missing out on some of the best growth opportunities within the market. But that isn't even the main risk that I see with a dividend-based strategy, a dividend-focused approach. From what I have seen, it tends to lead people into individual stock purchases, buying individual companies based on their dividend yield. So people dig into the numbers online, do tons of research and look for companies that have high dividends or strong repeatable dividends, and then go and purchase these companies individually. The problem with this is you're bound to run into headaches at some point. At what point do you sell? There will be emotional factors at play here. It's difficult to admit when you've made a mistake and cut your losses. Tracking an index doesn't bring you into these same sorts of issues. So you have to ask yourself, what is it that you know that the market doesn't? And is it worth your time and stress to be messing around with buying and trading individual companies? The third and final mistake that I'm going to cover is focusing on the wrong risks. In my book, there are three main types of risks that you might want to consider. The first of these is total capital loss. Kaboom, and the money's gone.
Then we'll reinvest the earnings into foreign currency accounts with compounding interest and it's gone.
Well, good news, we've solved this, and it's through diversification. Rather than backing a single horse and hoping it doesn't bite the dust, you buy thousands of companies spread across geographies and different industries, and you might even buy some different asset classes like bonds or property or alternatives if it makes sense for you and your financial plan. And in doing so, you remove the risk of total capital loss. The only way in which the money goes completely is if capitalism as we know it ends. At which point, I don't think you'll be that concerned about your stock portfolio.
You should put your money in bottles of water, bullets, blue jeans, and gasoline.
Practical things.
The second of these is volatility, and this is the one that most people latch onto when they think about what risk is. If it can go up and down in value, that's risk to them, and of course they're worried about the downside, and the bigger the potential for a downside, the riskier that is to them. But again, if you're holding a globally diversified basket of shares, and we agree that we've taken total capital loss off the table through diversification, then volatility should actually be welcomed, expected. All declines are temporary, and the advance is permanent. It would be naive to think that we would get higher returns than, say, cash deposits without putting up with some volatility risk. Risk and reward go hand in hand in that way. And for accumulators, people that are building their wealth, temporary declines in value should actually be very welcomed because you're getting more shares, more units in your fund at a lower price than you were previously, and naturally it will go on to a new high in future. And I do appreciate that if you are spending down your money, drawing on your money each month, each year, that it brings in a little bit more risk and the sequence of returns is more important. So that's where I would strongly recommend that you have a plan in place, that you stress test it, and make sure that you are on track and you've got the risk and return balance right for your own plan. And you could just take volatility risk off the table, right, and sit in cash. But there's a third risk, more of a silent risk, that isn't as obvious when you check your bank statement or log into your investment account. I think it would be safe to say that 2022-23 brought inflation back into the minds of most people.
How prices have gone up, double-digit inflation over there last year,
if it had ever left. But I do feel that there's a tendency to forget about inflation when we start to talk about risk, as if cash is somehow risk-free because it doesn't experience volatility. Well, yes, if you need money in the short term, volatility isn't appropriate, and I've spoken in many a video about the benefits of having a cash reserve. But for anything that you're not going to spend in the short term, that you are building for 5 years plus, 10 years plus out, you are going to have to fight inflation, and accepting volatility is one of the ways to do so. There is no such thing as risk-free. It's just which flavour of risk do you want to combat more? And I see far too many people shying away from volatility risk only to expose themselves to massive inflation risks. Think about what the average house price was in 1990 versus today. This highlights the impact of inflation. What good is money, the balance on your bank statement, other than what it can be exchanged for you and your family in terms of goods and services? So in summary, take total capital loss off the table by diversifying, and then consider the right balance to combat inflation risk versus volatility risk. It is unlikely that it's going to be in your best interests to have zero invested. So there we have it, 3 of the biggest and most common investment mistakes that I see when I'm talking to people about what they're doing with their money. Hopefully this gives you some insights and helps you avoid some of the investment traps that are set out there. My name's Andrew, I'm a chartered financial planner based in the UK. If you've taken anything from today's video, I would greatly appreciate you pushing that like button, as it does help in pushing the videos out to a wider audience. If you're new to the channel, tap subscribe for plenty more to come in future, and let me know in the comments your thoughts on some of the investment mistakes mentioned here, or if you've got any others that you want to let me know about. I'd love to hear about those, and hopefully I'll see you for the next video.